Real estate investment loan closing costs part 2. Get ready because it's time to raise the stakes with real estate. In a prior presentation, we took a look at closing costs in general. We're now going to take a look at the list of closing costs, simply listing them in alphabetical order, not in order of, say, the most expensive to least expensive. And then we're going to go through the first half of that list and describe those items in a bit more detail, followed by a future presentation going through the second half of the list in a bit more detail, remembering that these costs will vary depending on your circumstances, your location, and your lender. So you want to take a look at them and see if they would be applicable to you and your circumstances. These will be definitions. We're referencing Investopedia, which is a place you can go to further your research about definitions and terms that are investment related. So types of fees and closing costs. All of the closing costs should be itemized on your loan statement and closing disclosure. Some standard fees are application fee, the attorney fee, closing fee, courier fee, credit report fee, escrow deposit. Then we have the FHA mortgage insurance premium, flood determination and monitoring fee, homeowners association transfer fee, homeowners insurance, lender's title insurance, lead-based paint inspection points, owner's title insurance, origination fee, pest inspection, prepaid daily interest charges, private mortgage insurance or PMI, property appraisal fee, property taxes, rate lock fee. We have the real estate commissions, recording fee, survey fee, tax monitoring, tax status research fees, title search fee, transfer tax, underwriting fee, VA funding fee. Now we'll go into some of them in a bit more detail. Once again, just looking at alphabetical order, looking at the application fee, which is a loan application fee, may be charged by the lender to process your mortgage application. So that's in essence simply the processing fee here. Ask the lender for details before applying for a mortgage. We have the attorney fee, a fee charged by a real estate attorney to prepare and review home purchase agreements and contracts. Not all states require an attorney to handle a real estate transaction, so obviously those fees could vary. You may want to look at those in more detail in your circumstances. Closing fee may also be called the escrow fee, paid to the party who handles the closing. The party could be the title company, an escrow company, or an attorney, depending on the state law. We have the courier fee. If you're signing paper documents, this fee helps expedite your transportation. So clearly the courier is going to help you for signing documents and whatnot, but most of it might be digital these days, which may reduce the courier fees. When the closing is handled digitally, you might not pay this type of fee. Then we have the credit report. Credit report fee. This is charged from a lender to pull your credit reports from the 3 main reporting bureaus. So they're going to go through that process, and you're going to have to pay for the pulling and the paperwork on that, possibly. Some lenders might not charge this fee because they get a discount from the reporting agencies. So clearly they work with the reporting agencies a lot. If they get a discount, then possibly they may not be charging that one. And you could do some comparison shopping and so on. So escrow deposit. Some lenders require you to deposit 2 months of property tax and mortgage insurance payments at closing into an escrow account, basically a holding type of account to make sure things go through properly. FHA mortgage insurance premium. FHA loans require an upfront mortgage insurance premium, UPMIP, of 1.75% of the base loan amount to be paid at closing, or it can be rolled into your mortgage. Now, when you're talking about something that can be rolled into the mortgage, that means that instead of basically paying them up front, you add them to the loan balance, right? So now they're going to be in the loan balance. There's pros and cons if you are able to roll something into the loan balance. The pro is, of course, you don't have to pay it up front, and possibly you're stripped for cash at this point in time because you had to put money down. You probably put as much as you could down, possibly if you're a standard kind of home buyer up front, and then all these other costs could be difficult to put down at that point in time. If they were able to roll it into the loan, then that could be a way to pay it over the term of the loan, meaning your loan would be increase by whatever would be rolled into it. However, of course, the cost would be then now you're paying interest on it, because that's going to be increasing the loan balance and you'd be paying the interest on it as you pay it off. So there's also an annual MIP payment paid monthly that can range from 0.45 to 1.05, depending. That's 1.45, 1.05%, depending on your loan's term and base amount. Flood determination and monitoring fee. This is a fee charged to a certified flood inspector to determine whether the property is in a flood zone. So obviously this might be dependent. If you're in an area that floods, then there could be more concern about that. So if property is in a flood zone, it requires flood insurance separate from your homeowner's insurance policy. Obviously, if your house is on a hill or something like that, where not likely to flood, may not have that. So part of the fee includes ongoing observation to monitor changes in the property's flood status. Homeowners Association transfer fee. If you buy a condominium, townhouse, or property in a planned development, you must join that community's homeowners association. So this will be dependent on the type of property that you are looking into. If you got the HOA, the homeowners, then you could have the costs related to it. This is the transfer fee that covers the cost of switching homeowners, like document costs. So again, it's just the paperwork of going, homeowners thing is going from one person to another, and the paperwork involved administrative duties for that. Whether the seller or buyer pays the fee may or may not be in the contract. You should check in advance. The seller should provide documentation showing HOA dues amounts and a copy of the HOA's financial statements, notices, and minutes. Ask to see these documents as well as the covenants, conditions, and restrictions, or CC&Rs, bylaws, rules of the HOA before you buy the property to ensure it's a good financial standing and place you want to live. So clearly, when you're looking at an HOA, you're going to be dealing with the HOA as part of your community there. You want to make sure that it's a good place for you to be, as well as that you can cover the financial costs and you agree with, in essence, the idea of what they're going for with regards to financial costs related to the HOA. They're going to be high costs allocated there, or is it a low cost HOA kind of system, and so on. So homeowners insurance, a lender usually requires prepayment of the first year's homeowners insurance premium at closing. Lender's title insurance, this is an upfront one-time fee paid to the title company that protects a lender if an ownership dispute or lien arises that was not found in the title search. We have the lead-based paint inspection, which of course another kind of random thing that came up with the lead-based paint. You may pay a certified inspector to determine if the property has hazardous lead-based paint, which is possible in homes built before 1979. So that could be in a location-related costs and be based on the home and when it was built and so on. Points also called discount points refer to an optional upfront payment to the lender to reduce the interest rate on your loan and thereby lower your monthly payment. We'll take a look at points in a little bit more detail in future presentations and see how those points can be calculated and stuff and all that good stuff with the loan and whatnot. So 1 point equals 1% of the loan amount. In a low interest rate environment, this might not save you much money. So homeowner's title insurance, or owner's title insurance. A title insurance policy protects you in the event someone challenges your ownership of the home. So that's typically recommended here. We looked a little bit up this in the past. I won't go into it a lot of detail. It is usually optional, but very recommended by legal experts. So it usually costs 0.5 to 1% of the purchase price. And so we're going to continue on with this list in future presentations.